So let's get started. Okay, quick look at our agenda for today. We're covering 1. Introduction to accounting errors. 2. Principal versus clerical mistakes. 3. The 4 common errors. 4. Effects on the trial balance. 5. Steps to identify those errors. And 6. Fixing things with suspense accounts. Let's jump in. All right, Section 1. Introduction to accounting errors. We have all been there, right? It's the exact moment every accounting student literally dreads. You've done all the hard work, you've crunched the numbers, but when you look at that bottom line, the debit and credit columns stubbornly refuse to match. When this happens, we essentially have a financial mystery on our hands. The scales are tipped, and unintentional errors are always our prime suspects. But what exactly qualifies as an accounting error? Well, the absolute crucial word here is unintentional. These are honest mistakes. They happen either when you're collecting financial data or when you're in the trenches actually recording that info. We're talking about mathematical slip-ups, maybe a misinterpretation of facts, or just a simple oversight during the everyday crazy rush of business. So to be clear, it's not deliberate fraud, it's simply a human mistake in the accounting process. Moving right along to Section 2, Principal versus Clerical Mistakes. Now here's an absolute exam pro tip for you. All of these accounting mistakes can generally be divided into 2 primary buckets, which makes them way easier to memorize. First, we have errors of principle. These are conceptual misunderstandings. For instance, treating the purchase of a fixed asset, say a brand new typewriter or computer, as an ordinary office expense. You recorded it, sure, but you completely violated a fundamental accounting rule. Then, on the flip side, we have clerical errors. These are mechanical slip-ups made in the ordinary day-to-day accounting process. Think bad math or accidentally posting something to the wrong account. Which brings us to Section 3, the 4 common errors, or, as I call them, our big 4 suspects. So let's look at these 4 main categories. We just talked about principal. Next up is omission, which is just completely or partially forgetting a transaction ever happened. Then there's commission, which usually means writing the wrong amount, like, say, entering a credit purchase of $17,270 as $17,720. Just a simple typo, right? Finally, we have compensating errors, where 2 wrongs accidentally make a right. And the key detail you really need to remember for your exams is whether the trial balance will still mathematically agree despite the error being there. Let's look closer at 2 of the tricky ones. Take an error of omission. Imagine a transaction, maybe a big credit purchase of office furniture, is just left out entirely. It's not in the subsidiary books, it's not in the ledger. It's basically a massive missing piece of the accounting picture, leaving a huge gap in your financial puzzle. But here's the wild part. Because neither a debit nor a credit was recorded, your trial balance will still stubbornly agree. It completely hides the mistake. And then there's the compensating error. Suppose an amount of $10 received from client A is not credited to his account. Okay, that's a mistake. But if the total of the sales book is then accidentally calculated as $10 in excess, well, that increased credit completely makes up for the omission. You have 2 distinct, entirely unrelated mistakes that magically cancel each other out. And once again, your trial balance is going to look absolutely perfect. Okay, Section 4, Effects on the Trial Balance. It is honestly fascinating that a trial balance can look perfectly healthy, totally in agreement, while still hiding all these specific mistakes behind the scenes. So why do complete omissions, compensating errors, or errors of principle not break the trial balance? Because in every single one of these scenarios, an equal debit and an equal credit were still recorded somewhere. Even if you debit the completely wrong account, as long as it's a debit, the scales stay balanced. It's a 2-sided error, which means mathematically, the trial balance is totally blind to it. But then we have the 1-sided errors. These are the ones that actually break your trial balance and force you to put your detective hat on. For instance, wrong casting, which is just a fancy word for totaling of a subsidiary book. If January's credit sales were, say, $175,700, but you wrongly total it as $176,700 and post that to the sales account, well, you just inflated your credits without touching your debits. Bam, the balance is broken. Section 5, Steps to Identify Those Errors. All right, grab a pen, because here is your step-by-step exam checklist for investigating an unbalanced trial balance. Step 1, find the exact mathematical difference. Step 2, take that difference and cut it in half. Why? Well, think about it. If you posted a $500 debit into the credit column by mistake, your trial balance is actually going to be off by $1,000. So having the difference helps you instantly spot those transposed column errors. Step 3, recheck your castings, especially if the difference is a round number, like 1, 10, or 100. And step 4, if the difference is massive, zoom out. Compare the account balances with the previous year. If sales are suddenly $4 million less than last year, you know exactly where to start looking. Finally, Section 6, fixing things with suspense accounts. Now listen, if there is one golden rule you take away today, it is this. Never, ever cross out, erase, or overwrite a mistake in a ledger. Seriously, it makes the books look incredibly suspicious, and it totally compromises the audit trail. Any correction should always be made by passing a new suitable entry, what we call a rectification entry.
But what happens when the clock is ticking, you have to close the books, and you still haven't found the error? Enter the suspense account. I want you to think of the suspense account as a temporary holding cell for unknown discrepancies. If your credits exceed your debits, you just drop the difference into a suspense account on the debit side to artificially force the trial balance to agree. This lets you move forward and prepare financial statements while you continue to investigate the crime. Once you finally find the errors, you empty out this holding cell with complete final journal entries.
So, I want to leave you with a crucial question to ponder. If you use a suspense account and just kind of forget to empty it out tomorrow, what hidden structural weaknesses remain in your financial reporting? As you prep for your exams and your future career, just remember, artificially balancing the books, that's only step 1. Uncovering the real truth, fixing the root causes, and ensuring the absolute integrity of the financial picture, that is the true, invaluable job of an accountant. Thanks so much for joining me on this explainer, and hey, happy studying.